Hey everyone, this is Joseph. For those of you who don't know me, I used to work on the Fed's trading desk, and now I write a blog, fedguide.com, where I teach and write about the markets. Usually, my work is directed more towards those who are active in the markets, but I also get a lot of questions from people who would like to learn. And so I've decided that going forward, I would make a video explaining my blog posts. So today's post is called Hiking at $60 billion a month. It's a reference to the pace of quantitative tightening, which is $60 billion a month of US Treasuries. So what this post is talking about is how the transmission of monetary policy is going to be improved gradually through quantitative tightening. Let's break that down. So as we know, the Fed has been hiking rates over the past year, and it has gone from about 0% to almost 5%. But if you are like me, then when you log into your bank and see the interest that your bank is offering you on money in the bank, well, you're earning about 0%. So for you and for me, rate hikes have basically not happened. And that's true for vast swaths of the public. There's trillions and trillions of dollars of bank deposits that still yield zero. So the transmission of monetary policy isn't working. But I believe that going forward, QT is going to help with that. It's going to help with that in two ways. The first way is that QT mechanically takes deposits out of the banking system and in its place replaces them with Treasury securities. This matters because Treasury securities are sensitive to policy rates. So when the Fed hikes rates, that's reflected immediately in Treasury yields, whereas it's not necessarily the case in bank deposits. So in a sense, you are increasing the share of assets in the financial system that's more sensitive to interest rates, and there are going to be more people who are going to feel the higher interest rates that the Fed is doing. And the second mechanism that QT is going to help is that it's going to help increase competition for deposits. Now, going back to the first point, the Fed is, through QT, is going to decrease the quantity of bank deposits in the banking system. That means that banks are going to have to compete a little bit harder for those deposits, and logically, they're probably going to compete by raising more deposit rates, so offering higher interest rates on deposits. And that's eventually going to feed through and raise deposit rates. But anyway, let's go through and look in more detail on those two transmission mechanisms. Okay, so the first one about changing the composition of assets in the financial system. So at a really high level, the level of bank deposits in the banking system is really dependent upon two people, the Fed, of course, and the commercial banking system. Individually, households don't really have any control over the aggregate level of deposits in the banking system. When a commercial bank makes a loan, it creates a deposit. So when the commercial banking system is making a lot of loans and leases, as it has been over the past few years, it's increasing the amount of deposits. It's basically creating money out of thin air. That's how commercial banks work. The second way that deposits can increase is through actions of the Fed. So when the Fed is doing quantitative easing, it's increasing the level of deposits in the banking system. For example, if I have a Treasury security and then I sell it to the Fed creates money out of thin air, sends it to my bank, which in turn credits my account. So at the end of the day, basically, I have some deposits in my account, and the banking system as a whole has more bank deposits. If you look at this first chart here, you can see that the level of deposits in the commercial banking system absolutely exploded the past couple years. And that's a combination of tremendous QE and a tremendous boom in bank lending. Now, wow, if you look at that, that's a few $1 trillion. Now, if you look at the second chart, you can see that on average, the savings rate offered nationally offered on savings deposits is basically zero. And at the same time, you can see in red, the Fed has rapidly hiked rates to about almost 5%. And you can see that Treasury yields have reflected that, with the 5-year Treasury yield here shown in green also rising to about 4%. So at a high level, you have trillions of dollars of basically cash sitting in banks offering 0% interest when inflation is 5-6%. That's probably going to stir up a lot of speculation further, since rather than having money, basic purchasing power disappear through inflation by letting money sit in a bank, people are probably trying to buy lots of financial assets and speculate to try to get ahead of inflation. And so I think part of the reason why it seems that the markets have been so resilient to rate hikes is because the level of money, so to speak, in the financial system is so high, and rate hikes really haven't reached a lot of people. Now, QT is going to change that, because at a high level, what QT does is it's kind of like a big asset swap. So it's an asset swap in the sense that at a very high level, the Fed is going to take out bank deposits and replace them with US Treasuries. And for the exact mechanics of that, I'll link to a blog post where I break it down. But at a high level, that's basically what happens. And so every month, there are going to be fewer deposits in the banking system from QT. And in its place, someone, instead of holding a 0% yielding bank deposit, they're going to hold a Treasury security. The big difference between the two, well, one of the big differences between the two is that the interest rate offered by the Treasury security is very sensitive to the Fed's policy rate. So Treasury securities are actively traded in the markets. And when the Fed is hiking rates, the Treasury securities, the yield of Treasury securities quickly reflects that, which you can see again in the green line here, rising in line with the effective federal funds rate. So the Fed is basically kind of doing some sort of financial engineering by taking out assets that are not sensitive to the policy rate and replacing them with assets that are, in effect, increasing interest rates for a wider swath of people in the financial system. And that's going to have the impact of, hiking rates is usually going to dampen down a bit on the speculation and, in effect, tighten financial conditions, which is the whole point of quantitative tightening and raising interest rates. Now, the second avenue that this is going to help improve the transmission of monetary policy is by improving competition for deposits. Now, going back to our first point, tremendous amount of deposits in the system and deposit rates are very low. And part of that is because there's just so many deposits in the system, banks don't really feel like they need to offer higher interest rates to compete for their depositors. I mean, where are you going to go? It's 0% at one bank and 0% at another bank. But there is some indication that at least some banks are going to be willing to compete. And you can see that by the increase in borrowings from all commercial banks here, which I highlight in red. Now, that's telling you that someone in the banking system is in need of more funding. And the way they're getting funding is borrowing most likely from federal home loan banks, which are a special type of government enterprise that's designed to provide cheap funding for the banking sector. So if there's demand for funding, it stands to reason that eventually that kind of competition is going to trickle down into deposit products as well, for a couple of reasons. One is that under regulations, the banks are strongly encouraged to use deposit funding. So deposits are valuable to the banks, and they're probably going to be willing to pay up for them. And the second is that, as we noted earlier, every month there's going to be fewer deposits in the system via quantitative tightening, all things equal. So as the supply of deposits decreases, it's very likely that banks will gradually start to compete for deposits and thus increasing deposit rates and improving the transmission of monetary policy. So those rate hikes that the Fed has been doing may finally trickle through to the broader the broader household sector. Now, together, my own view is that this is probably going to be a meaningful headwind to risk assets going forward. It's going to have a meaningful headwind because you can think about the big interest rate differential that's really happening right now. So as time goes on, and okay, so in this chart, this is from a data aggregator called depositaccounts.com, which has really good data. They basically scrape a ton of websites on the internet. And you can see that the national average for a lot of deposit products is really very close to zero. But treasury yields, as we've shown, are yielding, say, 4% around the 5-year tenor and a little bit more if you go to shorter tenors. So the jump between getting 0% on your deposit to, say, 4% on a treasury security is pretty meaningful. And so every month, there's going to be basically $60 billion worth of deposits or deposit holders getting a rate hike from 0 to 4%. Back when we were talking about quantitative easing, many people were thinking that, QE and doesn't really do anything because you're just swapping one zero yielding asset for another zero yielding asset. Now, there's some logic to that, but now we're doing something very, very different. We're taking out a zero yielding asset and we're replacing it with a relatively high yielding asset. And so very soon, gradually, a larger and larger share of the market is going to feel these higher interest rates. And that's probably going to tampen down on their need to rebalance and thus their need for to speculate. Now, just as an aside for that, so when people are trying to escape 0% yields, they can do a lot of things. They can go to buy treasury bills, which I've written about, and they can go to a money market fund. But, oftentimes it seems that they also go into the stock market. And the reason is that I think, no one really knows what the return of the stock market will be, but we've have a long history of having very strong stock market returns. So I think the perceived return is quite high. So that's also a very natural outlet. Anyway, this is how mechanically this will play out, and we'll figure out in the coming months how this will exactly work. And if you've enjoyed this and you want to learn more about the financial system, you can check out my book here, Central Banking 101. Or if you're interested in learning more about the markets, I also have a course called Markets 101 that can help you. Anyway, thanks for your time, and I'll talk to you guys later.